Hello, my name is Natalia Francois, and I am here to share with you a financial analysis of First Citizens Bank Holdings Limited. Now, this analysis came across after several persons reached out to me asking whether they should invest in FCB, First Citizens Bank Trinidad and Tobago Limited, based on the company's recent additional public offering to the public of its shares. So I hope you enjoyed this session. Now, the purpose of this analysis is to, I don't want to say give advice, but it may be a recommendation whether you should make an investment in this new additional public offering. Now, a little about the company. Before I go to the company, let me just state this. So companies, they raise money either through loans, right, which is debts, or by issuing shares to the public or selling shares to the public. So that's how they make money to finance their operations, whatever they're into business doing. So we're assuming now that FCB is issuing or selling these shares to provide financing for its company's operations. Good. So a little about a company. You want to make an investment, any type of investment, you need to know about the company, what you're investing in. So just a synopsis, you can get more information on the company's website, their prospectus, their annual reports. All right, so they were founded in 1993 and was a subsidiary of, First Citizens Group. I think it's Financial Holdings Limited from 2021. So now they are subsidiary under this group, but they were founded in 1993. Their main purpose or their main areas of business is to provide financial services, right, in different areas of Trinidad and Tobago, Barbados, St. Vincent and the Grenadines, St. Lucia, and Costa Rica. That's where they have their operations. They also have some stakes in Term Finance and the Baratier Investments in Jamaica. Investment banking, I don't know why I have that. Investment banking, asset management, that's some of the services that they provide. No, that's just basic. When I read the company's annual reports for the last period, 2020, I'm looking for some strategies and plans in the CEO's report, the chairman's report, and the management discussions. Right? What I got from it, besides talking a lot about the challenges, their plans or their strategies really to create an opportunity or opportunities for growth for the benefit of all stakeholders. There was nothing very specific for me to reference of how they're going to go about doing this. The challenges, as with every other company, the effects of COVID-19. And we know there are so many effects from this virus. Again, go to the report and read more about it so you know the challenges the company will have. So in analyzing the financial, so I'm looking at the numbers, because the numbers tell us a story. What does all of this mean? I did a trend. So the trend takes us from 2018 to 2021. I did a 4-year trend. To see the performance, right? The trend helps us to compare different years to see what happened in the company. If anything significantly changed and what we could further investigate why, if there's this big change. So I start with the income statement. The income statement tells us, the results of the company's business activities, how much revenue was generated, and what costs were incurred and how much profit was earned. So if we look at the revenue from 2018 to 2019, we can see a increase approximately 3% from 2019 to 2020, a decrease of 2%, and from 2020 to 2021, a 4% increase. So there's nothing significant really about the company's revenue. It's basically consistent, have been consistent during those years. So if we were to forecast, we could probably say, we could probably see what it will be for us in 2022 if we were to make that type of investment. I want to let's look at the profit for the year. So that's this blue bar right here. So bear with me. Even though I'm doing an analysis, I am an educator, so I can't help but teach while I'm doing this analysis. So if we look at the dark blue bar that is there, we'll see the profit for the year. Again, it's very constant, right? There's no significant change. We see like a 4% change between 2018 and 2019. We see a decline about 7% between 2019 and 2020, and then it increased again by a 3% between 20 to 21. Again, there's no significance in the profits that have been happening the year. The company is still making a profit, but no significant profits. I go to the balance sheet statement of financial position, and normally this will tell us, what the company owns, what it owes, and what portion of, the debt and the equity was financed with assets. So we can see assets, the light blue bar here. Again, not much growth or much change, no significant change. What I want to comment and say is that the assets, what I found, assets accounted, the largest portion of assets was loans to customers, right? It was about 70% of total assets, while the next assets were, so loans was like 40%, and the next largest assets were investments in other securities, right? That was about 24% over the years, average about over the years. It's very consistent across the years. When we go to the liabilities now, again, there's no significant change in debts. We just see a little peak in 2020. The company increased its debts, which is customer deposits. And that accounted for the largest portion of the liabilities or debts. It's approximately about 72 to 75% of the company's debts. So if this is the total debts, it's accounted for about this amount. All this was customer deposits is the largest. Shareholders' equity. Now, the shareholders' equity is the stocks that people invest in, right? Which you are considering investing in. See, it is consistent. There's not much change. And looking at your graph, you can realize, well, what you see is that this is represent your assets. So your assets, as said before, they are financed. The company are financed the assets either through its debts or its equity. And we can see from this that the company is mainly also concerned, or what is significant, the company is heavily financed with debt, particularly customer deposits as opposed to, the shareholders' equity or return. And go to the cash flow trend. I looked at the company's cash flow statements. Now, a company generates cash either through its operations, what it went into business to do, operating activities, investing activities, means buying capital expenditure, our financing activities, which is, the purchasing of securities, stocks, the issuance, of securities, and the paying of dividends, interest. So we can see here what is significant about this. From this trend, for me, the company mostly generated money from its operations, which is good. They're in business to generate money from its operations, which is interest, mainly interest from loans. And when it comes to investing activities over the 4 years, they heavily invested in other securities. That was significant to me. And the financing activities, they didn't issue any new shares, or bonds, but they paid out dividends and interest on its bonds very consistently. Now I'm going to ratio analysis. Now, why ratio analysis? Ratio analysis gives us a clearer picture of what happened. It helps us interpret the numbers. So we look at the trend of what happened, but let's interpret what these numbers are saying. So the ratio of profitability of the company tells us the ability of the company, to generate profits from the capital invested, which is the shares invested, any money that's invested. So there are several ratios you can use. I just want to focus on, not to make this video too long, return on equity, because we're concerned about the share that we want to purchase, we're considering purchasing. So the return on equity is based on this capital that's invested. The higher the ratio, the more income or revenue, what we saw in the previous income statement. Here, the average is consistently at 8%. So when we're looking at it, it's consistently at 8%. It means for the shareholders' money that they're putting in, 10% of it is 10% here, 11%, 8%. 8% is responsible for the company's total revenue, right? Only contributes to about 8% of the total of the company's revenue. That's very significant to me. If I look at earnings per share tells us, what each shareholder, so me, I'm a shareholder, considering being a shareholder, owns, so each shareholder, I should say, each shareholder owns different number of shares, right? So you $50 a share right now, you may buy one share, another person may buy 2, 10, and so each shareholder will hold different amount of shares. So it tells the shareholder what his or her share in this company's earnings or profits, right? So for each share, let's say in 2021, shareholders earned $2.64. Statement had that, $2.64, right? So for each share that the person had, it generated an earning of $2.64, right? Then we go to the solvency ratio. I'm concerned about the solvency ratio because solvency ratio tells us about the company's ability to pay its debts. And we saw in the previous trend that the company is heavily financed with debt. So what is this company's position? Can it pay all this debt that it is generating? We see the debt ratio, right? 83%, 84%, 84%, right? So the debt ratio tells us the portion of the company's assets that is financed with debt. So the company has 100,000 in assets. 84,000 of it is financed with debt. Finance means this is how they got the assets. They borrowed money, right? Financial leverage now tells us how much equity supports these assets. So that means the share value, the shares. How much of these shares supports these assets that the company owns? We have an average of 6. You can see here, we have an average of, let's say 6. We have an average of 6. This means that for each dollar of equity or share, it can support $6 of total assets. So the higher the leverage, the more leverage we can see. The higher the leverage, the better. But we can see for 2020 and 2021, a slight dip. Cash flow adequacy tells us if the company has enough cash generating from its operating activities after it has considered its investing activities and its financing activities. So after it's considered its capital expenditure and the dividend payments, can they support the company's operations, salaries, maintaining its compound, customer service, that kind of thing, marketing? Do they have enough money to maintain those, this production, it's at capacity, without, letting go workers and that kind of thing? We can see here, a negative would mean that, they don't have enough cash, which we see was in 2018 and 2019 to maintain its operations, but you see an increase within 2020 and 2021. That's the brown bar here. Right, so it's a they have a positive cash flow to maintain its operations. And finally, and most importantly, our investment ratios, because we're really concerned about this share price, right? We look at the PE ratio. They say this is the most important ratio for an investor. It expresses the relationship. So it's a relationship between the price per share and the amount of earnings or profits attributable to a single share. So in other words, how much does your share make or pay? How much does your share pay to make profits? Right, so in this case, if we see a P ratio of 19, we're seeing a P ratio of 19 for 2020, 2021. If we were to make a prediction, we could safely say it will be 19. It may be 19 or 18 for 2022. And what does that mean for us? What's the price of the share would be? It will be 19 multiplied by earnings per share. The earnings per share for 2021 was $2.64, which is equal to $50 and 16 cents, $50.16. $300 is $50. And yeah, that's the price the share is selling at. So the share may be at the correct value. The share is at the correct value. For most stocks, the P ratio carries a P ratio of 10 to 20. 10 means you have a bargain. If you, over 20, this stock is expensive. Because it means that for the investor must pay $20 for each dollar of earnings per share. So here's an expensive stock. It's selling at $50. Now, no, the dividend payout ratio, right? So I did the PE ratio, which we said may be the most important ratio. Dividend payouts, because you're investing in this to get a return, right? So you want to see what's the dividend look like. It measures the percentage of earnings that the company pays out as dividends to the shareholders. Here we want to look for a steady stream of dividends over a long period of time as a sign that the company has a steady performance record. So here we see 54%, 57%. So the company is paying out the earnings that it makes, it's paying out more than 50% of its earnings. So its shareholders, it's giving back to shareholders the profits that the company made, right? Sustainable growth rate is another ratio you want to be concerned about here, because this measures the, let's say, the return on the equity of the shares that you invest and the ability to finance itself, the company, the ability to finance itself from internal generated funds. So we are seeing here some growth rates. We're seeing some growth rates really small, very small, very small by some points, really, or none at all. But it's still positive. So, you know, the higher the growth rate, the better for this company. But right now we're just seeing it's just going by some points. I have here finally market capitalization, net book value, just to mention that the market value is, you know, what the business is worth on the market, you know, what it can sell for. If an investor is looking to buy them over, they will be able, this will be the start a negotiating price, right? Net book value now will represent the real value, the value on the books, the assets minus the liabilities, right? So from here we can see what, so the book value is, I can't see those figures, but we see the market capitalization is bigger or more, meaning that what the market is willing to pay is greater than what is on the book. Yeah, that's a positive. Now, I have here my conclusions. I put them together, my concerns and my recommendations. Now, the company has performed well. It has performed well over the past 4 years in spite of the pandemic. We didn't see any losses. We're seeing that the company can finance its debts. We are seeing that the company constantly pays, through its profits, it pays its shareholders dividends. We're seeing the revenue. It hasn't dropped. It's been very consistent. But in my research, there was no management discussion, you know, about the company's plans or strategies to improve on its performance, right? While they say they want to improve it, there was no discussion about what they plan to do to improve it, right? The company is heavily financed with debt. That's a concern, you know, even though it shows that it pays its obligations, it is paying its obligations. You know, I believe from my analysis, the company is raising money, right? They issue the shares so they can raise money. So from my analysis, I believe the financing activities are being used to pay off, you know, some of the debts. So they are using this money that's we would give them to pay off some of these debts, because again, there was no plans for, I didn't see any plans for certain types of capital expenditure. I don't foresee, I should say, an increase in the share value for the investor or an increase in the dividend payout. So buying a share, you benefit from the share by the dividend and the increase in capital, the increase in value of your share, right? So I don't see an increase in the price of the share in the short term for an investor. The dividend payout is consistent, but I don't see an increase in the share value. Foresee an increase in the share value in the short term. Now, My recommendations is that you, before you make this investment, you compare with other financial institutions or the other industry, if you have that money to invest, before making an investment in these FCB shares, especially if you're looking for, a long-term growth. It's not a bad investment, but there are other investments, and a comparison should be made. Where's the best place to put your money? Not because the option came up, but there are others around. Make the comparison before you decide to make this investment. Now, thank you for watching. Like, comment, subscribe. See you in the next session.